In this lecture, we're going to look at IFRS 15, focused particularly on revenue recognition. So this is a quite important standard, one of the new standards released in the last couple of years, and it had huge changes in the financial reporting world. So IFRS 15 and the more recent one, IFRS 16, covering leases, are the two big fundamental changes that you'll come across when you go out to the working world still, because it's taking a big transition. So the background here is your revenue line item is one of the most important, the biggest line item often in financial statements. It's a core benchmark in terms of looking at revenue growth or revenue decline, and it's even used for valuation because some companies can be valued at a multiple of their revenue. So again, it has very important connotations inside in business, but unfortunately it is common for fraud and manipulation, so the overstatement of revenue, revenue fraud, etc. And that's why we need clear rules around it. And the problem was that the new business models we have now, so the likes of advertising business models of Facebook, LinkedIn, etc., they weren't really there when the original standard, the old standard for revenue, which was called IS18, it was quite a very small standard. It just really envisaged the sale of products and the sale of services. It didn't envisage this whole idea of selling goods, selling advertising, and getting paid based on the number of clicks you have, for example. So we needed to adapt the revenue recognition standards for the new business models. So the core principle is you don't recognize revenue until it is earned. Now that's quite straightforward when you sell a TV or you offer a cleaning service. You know when you earn the revenue, when the TV is handed over or when the cleaning service is actually offered. When we start getting to more complex deals around, for example, advertising contracts in a company like Facebook, or different transactions you might have in the online environment, the likes of Airbnb or Uber, how do they recognize their revenue? It gets a bit more complex. Right? And I suppose what they're worried about now is the deliberate misstatement of revenue. So the common cases like Enron or WorldCom, which you'll come across in your corporate governance modules as well, and maybe even your audit modules, they're classic examples back 10, 15, 20 years ago of where things went wrong. There was the deliberate misstatement, usually overstatement of revenue. And in more recent times, if anyone following the news or want to Google it, have a look at the the Tesco revenue issue. It's around 2014, 2015, where a number of the Tesco managers were overly aggressively recognizing revenue. The reason were they had to meet sales targets and they felt they weren't going to meet them. So they over-recognized revenue too early to get to their earnings targets. And then it all came out and it had a huge impact on Tesco's share price. So you can see here on the slide some of the methods of revenue manipulation so recording the sale before delivery, which we call aggressive revenue recognition. So you recognize it before you either deliver the product or before you deliver the service, or just purely false sales agreements that you're trying to artificially boost your revenue, because that gives a more healthy perspective to your financial statements as well. So IFRS 15 came into effect for 2018 onwards. Before that, there was a big collection of standards, the old standards, IS11, IS18, and a load of different things we call IFRS, which are really just interpretations of the standards themselves. What we want to get you across is you don't need to know those in detail. The point is we're trying to bring one single standard now, replacing all the old ones, which were there for 10, 15, 20 years themselves. And what we're also trying to do is they were trying to get some harmonization between the international accounting standards and US GAAP. Because of course US GAAP have a whole different set. In the US, they do not use international accounting standards. They use their own generally accepted accounting principles. So this was a joint project accumulating in IFRS 15 and the equivalent in the US for their revenue recognition as well. So there's this whole idea move towards global harmonization. So it's quite an important one. But if I just show you here, this is the IFRS 15 standard in IS+. Just to give you an idea, this project started back in 2002. It was only came into effect in 2018. So 16 years it took them between lobbying from accounting firms, from companies in the industry, from issues in terms of international accounting standards, technical issues, and liaising with their US counterparts. 16 years in total it took from the initial discussions, adding it on the agenda, to actually getting it into effect. So you can see here, setting a standard is quite a tedious and long drawn out process. And we would have seen that in semester 1, the whole idea of accounting theory helping to explain some of that as well, and the politics involved. So the main reason to bring it in was there was limited guidance in the old standards for the complex transactions we see now. So with the online payment per click, all of those complex ones, it didn't really give us any clarity, because IS18, the old revenue standard, was really only issued when there were sales of goods and supply of services. There was no internet, there was no such thing as e-commerce. So we had to try and get a more robust framework. So you have a lot more detail here, and it's quite complex, and because it actually has 3 or 4 years even of a lead-in time to get companies the time to transition over to IFRS 15. So this was a huge change, and will continue to be a huge change for the next couple of years as companies get used to the requirements of this particular standard. So it was a big change. So the whole objective of IFRS 15 is these key elements here, right? It's trying to give us more information around the nature of revenue. So where you're getting your revenue from, the amount of revenue you're earning, the timing of it, and if there's any uncertainty, i.e. is it risky? Is it a contingent revenue? So it's contingent on something happening. So the key point there is it's all about disclosure and letting the users of financial statements understand, look, where are you earning your revenue? What types of category of revenue do you have? How do you recognize that revenue? For a business, some of them, it'll be very straightforward, whereas for others, they could have complex contracts. They could have a load of different sources of revenue. So you need to understand that if you're going to invest in this company or be a stakeholder of the company. And the core principle here is you want to recognize revenue based on the transfer of promised goods and services. So you want to figure out, well, what are the promised goods and services we're giving to the customer, and what is the consideration in exchange for those? So at a high level principle, it's very straightforward. There's a contract or a promise to deliver goods or to deliver services or to deliver both to a customer, and there's consideration. But where we get the complexities then is that's what IFRS 15 is trying to help with. And what we've moved away from is kind of general principles, which was in IAS 18, to a very set kind of 5-step model. And you should be able to explain this 5-step model if it was asked in an exam. What are the 5 steps, and what are some of the trouble you'll have within each of those 5 steps? So the first step is to identify the contracts. Now this is generally a straightforward one, but it's an agreement between the two parties, but the key point here is it doesn't have to be written. So IFRS 15 says you could have a combination of contracts, you can have an oral contract, you can have an implicit contract based on past practice. So that's a fairly straightforward one, but it is the first key step, is what is the contract? Is it written? Is it oral? Is it implicit? Is it explicit? That's a formal document in place. And sometimes there's a combination of contracts based on whatever type of agreement it is. But that's generally a straightforward one to start off with. Then you're trying to figure out what are the key word here, performance obligations. So within that contract, what do you have to do? What do you have to perform? And that's the promises. So some of them are promised to give the customer goods. Some of them are promised to give the customer services. But you could have, for example, a bundle of promises. So if you have a bundle of promises, so for example, if you go and you buy a phone, often the time in those Carphone warehouse and whatnot, you'll be getting a handset and you'll getting a 12 or 24 month contract, right, for phone services. But the key point there is they're two distinct promises within the same contract. So the promise to deliver a good, the handset, has to be shown separately and accounted for separately. And in the 24 or 12 month contract, that's another distinct good or service. That has to be accounted for separately as well. So that's important when you get to, for example, you might buy a laptop and have a 1-year service plan as well. They are two distinct promises and they must be accounted for separately. So we start to get a bit more complicated, particularly for mobile phone companies. This was a huge change to what they were used to before. So once you have what the contract is, you have to figure out how many promises there were. Is there one promise overall, or is there distinct separate performance obligations? You then, well, what is the price? So what's the price of the contract that was agreed? The price could be fixed, and that makes it relatively straightforward. But another key thing is you could have what we call a variable price, or what we call variable consideration. So for example, you may or may not get a volume discount depending on how many you buy.
Yeah.
So why we call it variable is it may or may not happen. So you're going to have to estimate, well, am I going to have to pay for that? Am I going to receive that money? It depends on something happening. So rebates or bonuses, they're what's called variable consideration. And so we'll look at how we account for that. And you might also have to account for time value of money. Because if you're not getting your money for 2 or 3 years, technically that's not a sale today. Right? At that money, you're essentially giving them a loan for some period of time as well. So you have to count, is there a significant financing component? And we'll see that in a couple of the questions, particularly in the question pack. So once we've figured out what the overall transaction price is, we then have to allocate that price to each performance obligation. So remember, going back to your phone example, if I now sign up to a contract for a 1-year contract at €30 a month, which is €360, there's actually 2 things going on there. Some of that €360 is for the handset. Some of the €360 is for the use of the network over the 12 months. And in IFRS 15, you have to allocate that out. You have to figure out what portion of that overall money that the customer is paying is attributable to the handset, what portion is attributable to the actual 12-month contract plan. So it gets a bit more complicated, and we're going to go in detail then, well, how do I allocate that out? Well, what are the key things I need to look at, and particularly what are the debits and credits? Because the last step is, when do you recognize the revenue? Right? And you recognize the revenue by performance obligation. So if you have 2 different performance obligations, now remember, performance obligation, same as a promise. In the mobile phone contract, we have 2 performance obligations, or 2 promises. One is to sell the customer a handset, which happens on day 0. So once that handset is handed over, that sale can be recognized, depending on what portion of the transfer price we allocated to that phone. The contract plan over the 12 months, that will be allocated on a month-by-month basis as the bill goes out. So that's what we mean there by recognizing revenue. You're either going to recognize revenue at a point in time for the transfer of goods, for example, there the handset or the laptop, or over time in the case of your contract to access the Vodafone or whatever network, or for example, a service agreement for your laptop. So that's important to understand how many obligations you have and when it should be recognized. Because you can't recognize, for example, the revenue attached to a 12-month contract up front, because you haven't earned that revenue. It's the same with a gym. A gym cannot recognize your annual membership on day 1 because they earn that annual membership over the year. Regardless of whether it's refundable or not, you have to reflect when the revenue is earned. So we do get more complex. It's not as straightforward now as you'll have done in maybe Leaving Cert and AF1 and up to date, where you just recognize the revenue when you're told. When you get to the real world, when you get to bundle deals and more complex offerings, we need some solid rules. And the 5 steps of IFRS 15 are your starting point. So in terms of complexities then, so we said your contract's agreement between 2 parties, they're the key things you're looking for. What are the criteria do we need? The contract must be approved. So you must show evidence that both parties approved it, either in writing or orally. Each party must clearly know their rights. There must be clearly payment terms. Now this one is an important one, the commercial substance. It must not be a false agreement. So for example, party A and party B pretend to sell each other goods, whereas it's completely false from a commercial perspective. The only reason they're doing it is to boost their revenue. So they might do a barter arrangement where one swaps goods for the other, but both revenues go up. So it must have commercial substance. And finally then, it must be likely that the entity will collect the consideration. So you're not making this sale to someone or to some company that's never going to pay you. It must be a transaction that has substance. And how you look at that is it probable that this company is going to collect money off the customer? So that's a useful way of thinking about it. One particular practical trouble that comes in these particular situations, particularly for the contract step, is the company a principal or an agent? So what we mean by that is the company actually taking on the risk? So is this company, for example, does the company control the promised good or service before it's transferred? Or are they merely an agent or a middleman in providing the goods or services? So an obvious one to think about an estate agent. An estate agent, if they make a sale of a house, they would never recognize in their estate agent financial statements the full price of the house, because they never owned the house to sell it in the first place. They weren't the principal. That was the person selling the house. They're merely the agent. So the only revenue the estate agent would recognize is their fee, their 2 or 3% or whatever it is. Same with, for example, Ticketmaster. Often the time Ticketmaster or those types of StubHub or whatever you use, they don't actually own the tickets. They're merely the middle person providing an agent services to match the seller and the buyers. So Ticketmaster technically don't own the tickets to sell them on, so they won't recognize the gross amount of the revenue. They'll only recognize their fee for the agent. That's an important one, because you could have two drastically different set of revenue figures depending on whether you're a principal or agent. Right. So what you're looking for, what are the key indicators? Does another party is primarily responsible for filling the contract? The entity does not have inventory risk, in the case that it doesn't have to package the goods. It's not in trouble if the goods don't turn up or they get lost. The entity does not have discretion in establishing prices. The entity's consideration is in the form of commission, so they don't get the full amount, and it's not exposed to credit risk. What they mean by that is, if the customer doesn't pay, the person in the middle doesn't lose out. So the likes of Booking.com, they would all be agents. All right. Now there can be small exceptions, but in general, these types of ones, like Booking.com, they don't lose money if the hotel rooms aren't sold. They just get a commission, and those fees are generally agreed with the hotel beforehand. So that's an important one that you understand. Is this a principal or an agent? Because that will dictate, do I recognize the full sales transaction, or do you just recognize your fee associated with that transaction? So take, for example, this entity here. They operate a website that enables the customer to purchase goods from a range of suppliers who deliver the goods directly to the customer. So not dissimilar to the likes of Booking.com, which offer hotels, these offer goods instead. Goods purchased via the website, the entity is entitled to a 10% commission. The website facilitates payment between the supplier and the customer. Note that price is set by the supplier. So actually this website doesn't deal in the payments, nor do they deal in setting the prices. They're merely the middleman in providing a platform for these suppliers. It requires payment before the orders are processed. The orders are non-refundable, so there's no credit risk, and they've no further obligations after arranging the product. So it's clear here, this website, whatever you want to call it, that is an agent. It doesn't take on the risk of setting prices. It doesn't take on the risk that the customers won't pay, and it doesn't take on post-sale customer service. Nothing to do with that. Very similar to the likes of Booking.com, where once Booking.com are finished, most of it is going to go through the hotel. So that's the key issue here, is if it's a middleman, you're an agent, you're not a principal. Right. So take this example as an alternative. So an entity negotiates tickets with major airlines, purchase tickets at a reduced price, then sold directly by the airline to the public, or compared to what they would sell directly. The entity agrees to buy a specific number of tickets and must pay for those regardless if they resell them. Right. Reduced rate is agreed in advance. Entity determines the reselling price, and they collect the consideration up front. So there's no credit risk. And they have to deal in resolving complaints with the service provider. Right? So this is a completely different dynamic. Why? Because the entity you're looking at, it actually buys them off the airline at a certain price and then sells them on. But the point is, if they don't resell them, they lose the money. So they are taking on the business risk here. So this entity that sits in the middle between the airline and the flyers, this will be a principal, because they're not just getting a percentage commission now, they are making a profit based on what they buy the tickets at and what they sell them at. And if they don't sell the tickets, they lose the money. So it's a completely different dynamic than the previous one where they just sat in the middle and got a commission. So watch for that when you're looking at questions. That can be an important one, particularly in today's business environment, where you look at the likes of Amazon, you look at the likes of Uber, Booking.com, Ticketmaster. A lot of these have the appearance of agent businesses, where they sit in the middle, they earn a fee, but they don't actually take the business risk the like of Just Eat, those like that, where they sit on top of suppliers and they provide a kind of user interface. But that's an important one for IFRS 15, that it's accounted for correctly in terms of revenue recognition. Otherwise, if you incorrectly treat it as a principal, the revenue would be huge, but it would be very misleading. So that's an important aspect to understand. Your next step then, once you've identified the contract and the type of arrangement is, whether it's a principal arrangement or whether it's an agent, is you determine what the performance obligations are. Now remember, performance obligations are your promises. What are you offering or giving to the customer? And importantly here, are they distinct? So every time you have a distinct one that can be looked at separately, you have to look at them separately in terms of recognizing the revenue as well. So for example, you can have the sale of goods. You can have the sale of purchases. So you can, the sale of goods. You can have the resale of goods by an entity. So you can either produce them and sell them or buy them and resell them, right? You can resell a right of goods, services purchased by an entity. So again, you can be a reseller, but acting as a principal, which is the example we saw previously. You can provide agreed upon tasks, so cleaning services, or you can provide a service standing ready to provide goods or services. So unspecified updates to software when they're available. So there's a lot of different examples, and you can just think of any type of ones. You can sell a laptop. You can also sell a laptop maintenance service. You can sell a handset on its own. You can sell a SIM-only deal where you don't sell the handset for a mobile phone, or you could sell them as a bundle. So that's where you have to watch for is, when you've identified the contract, you then have to figure out, well, how many promises are in that contract? Because determining the promises, you have to then allocate money to each of the promises to be able to recognize the revenue. So it is logical steps from 1 to 5, but it gets complex when you get to the real world. Right? So you assess how many promises there are. So identify as a performance obligation each promise. So how many distinct promises do you have? And it can be only distinct if the customer can benefit from it on its own, and the promise is separately identifiable. And the example there, the good one, would be the mobile phone plan. The handset is identifiable on its own, and the contract plan is identifiable on its own. Now, they are used together, but they can be sold separately as well, because you can get a handset on its own, and you can get a SIM-only plan. So that's important when you're looking at mobile phone companies. Well, how do you split that revenue then? So example here is a good one. So software developer enters a contract with a customer to transfer all of these. So it's a bundle package. Software license, installation, software updates, and technical support for 2 years. They also sell all of the above separately, and the installations are routinely performed by other entities and does not significantly modify the software. Software remains functional without the updates and technical support. So what they're trying to tell you there is all of these 4 are independent. So they're all different promises. You can sell the software on its own. You could do installation on its own, because you could do it for a third party. You do software updates on its own, because software remains functional without the updates, and the technical support is on its own. So in this case, you have actually 4 distinct what we call promises or performance obligations. So what a company would actually have to do here, they'd have to say, well, what's the bundle of money, the contract here, and then allocate that to each one. Now, it's not as simple as allocating it divided by 4, but that's what step 3 does, is determine the transaction price, and step 4 is, how do I allocate it out? So it does get a bit more complex when you get to the real world, and that's why it took so long to transition into this. It was a fundamental shift in how revenue was recognized. But in that case here, there would be 4 performance obligations, because they're all distinct promises that can be used separately. So once you've determined the promises, you then look at the overall transaction price. So that's the amount of consideration that's going to be given or expected in exchange for the goods or services. If it's fixed consideration, it's easy enough. So the contract is 100 grand. The tricky thing though is when you have variable consideration. So this is consideration you're not sure how much it's going to be. So for example, there could be a bonus involved, but you don't know until the amount of units are ordered. Or there could be a rebate or a volume discount. That's what we call a variable consideration. And you could also have sales with a right to return. So for example, you sell goods, but you allow your customers the right to return them for no reason within 3 months. But that means the sales you make today, you may not actually make them sales because they're returned. So IFRS 15 says that's a variable consideration. You have to estimate what you think it will be. So that's why we say expect up here, because it's not guaranteed. And we'll look at how do you account for that as well. So your variable consideration here, it has to be estimated. That's because you could have discounts based on the volume, which you won't know until the future. You could have rebates, performance bonuses, etc. Right? So that's one reason why you might have variable consideration is, and that can happen. So for example, when a company like Kellogg's or a company like Unilever sell goods into SuperValu or Dunn's, you're probably selling on the basis that you will offer a discount if a certain volume is hit over the year. But when you're recognizing earlier on in the year, you have to estimate whether or not you expect that volume to be hit, because you have to figure out whether or not to recognize the discount or not. So it's a bit more tricky. You're going to have to estimate what the variable consideration is. And of course, that estimate may be right or wrong. But that's the whole logic of variable consideration. And it can also change because, as we said, a right of return. Whereas you're not sure how many of the goods are going to return, but you know in past experience a certain amount will. So you're going to have to calculate them. And essentially what IFRS 15 says is, they place a limit. You can only recognize revenue where it's highly probable that you're not going to have to reverse it in the future. So what that point means here is, you shouldn't recognize revenue now for goods that you expect, for example, to be returned in 2 months' time. Or you shouldn't recognize revenue now for something that you're going to have to give back to the customer as a rebate or a discount in 2 or 3 months' time. So you have to look at what's your best estimate of what the variable consideration is and recognize that today. So it's quite tricky, and we'll look at a small example to illustrate that. All right. So this example here, your Denver entered a contract to sell beds on the 1st of January 2015 for €400. But there is a clause here that you will give them a discount of €20 per bed if they meet a certain volume, i.e. 1,000 beds. So it's a volume-based discount, not untypical, but they have to buy 1,000 beds first. And this contract price consideration is variable. What we mean by that is it's unsure. It might be 400 a bed, but it might be 380 a bed if we sell more beds. But if we're making, for example, at the 31st of March, Denver sells 80 beds. But they also estimate that the 1,000 bed target will not be exceeded. So in March, how will you account for the 80 beds? Well, you don't expect the discount to go through because you don't expect the customer to qualify. So that means you would recognize those 80 beds in March. It will be debit bank. So we'll just debit trade receivables because we're not sure if it's paid or not. Probably cleaner that way. Debit trade receivables, credit revenue. And what you're going to recognize there is 80 times 400, which is 32,000. So in March, you would recognize the full amount of the revenue because you don't expect the variable discount, the variable consideration, to be met. So that's what you would recognize in March. But look at what happens then come to June. Beginning of June, they acquire additional 500 beds, so a big jump in volume. And in light of this, they have actually changed their expectation. That's why it's called variable consideration. They now do expect the customer to exceed the 1,000 bed target by the end of the year. So how do you recognize revenue now for the 500 beds in June? Right, so what you'll do in June then, if we look at it here, your June, you're going to debit trade receivables and you're going to credit revenue. Now, be careful here. There is, if you think about it, there is 500 beds sold, so it's going to be 500, but it's actually going to be 380. Why? Because you now expect the customer to exceed the 1,000 bed target. And what IFRS 15 says, remember here, it's not that any bed above 1,000 beds gets 380. It's that if you hit 1,000 beds, every bed is going to be at 380. So you'll retrospectively go back and do all for that year. So that means if you expect the target to be met, you will recognize that revenue at 380, 190,000. because you expect that's how much you're going to earn from them. You don't recognize it at 400 and come back at the end. That's not allowed. But once you expect the discount to be qualified for, you recognize it. But we also then have to adjust the March sales. And you're going to take off 80 beds at €20. So you don't go back and adjust the March one, you put it through in the June transfer. And what you're saying is now our expectation has changed. We no longer expect to be able to recognize €400 per bed for the 80 beds. Because you expect them to qualify for the discount, you're going to recognize it at 380 now. So that means the revenue you're going to recognize there is 188,400. And if you just double check, if you recognize both revenues, 220,000, and you divide that by 580 beds, which is what you've sold to date, it's your 380. So that's where IFRS 15 wants you to do is, as your expectations update, you update your revenue recognition. You don't go back and readjust here. You just adjust from the current period and move on that way. So that's what we mean by variable consideration, because your expectations can go up or down. So for example, if it came now in October and they said they only bought another 100 beds, and now they don't expect the actual customer to exceed the target, you go back and readjust everything up to €400 per bed. So these can swing and change, but from an audit perspective, you need to make sure that you're comfortable that the expectations have some validity to them. That you can't just change your estimate time and time to manipulate revenue. There must be some contract and some evidence behind it. So that's an important one, that how you change your accounting depending on whether you expect the variable consideration to be met or not. And the variable element here was, am I going to earn €400 a unit, or am I only going to earn 380? So how you estimate the variable consideration is either based on the expected value or the most likely. So if you're given probabilities, you're going to weight them based on probability, or if it's a single outcome, for example, you're going to get a bonus or not, you look at the most likely outcome. So this is very similar to what we did in IAS 37, where if you have a large population, for example, retail, you look at what percentage of that body and you look at a weighted average. Whereas if it's a single outcome, like a bonus, similar to what we had in IAS 37, like a legal case, you look at the most likely outcome. Right? So that's where we're going to stop it for the first part of IFRS 15, because it's quite detailed. And if you look at here, we have a good bit more to go through in part 2, which we'll leave for another lecture. But for that purpose, what you want to cover off in IFRS 15 for part 1, you want to make sure, number 1, you get an idea of the background to revenue recognition. And I have given you a nice little article there in your loop, the role of revenue recognition and performance. It's no harm to have a read through that if you get a chance. You don't have to read all of it, but particularly the first part of it is nice to give you an idea of the importance of revenue recognition and why it's such an important area and why it took so long to get the standard through. The other key thing then to have an idea of, understand the 5-step model and what are the key things in each one. We've only really scratched the surface in the first couple, particularly when we get back now, we will look at sales and rate of return, and we'll also start looking at allocating transaction prices. We'll get a lot more focused on journal entries and debits and credits as well. So that's part 1, looking at IFRS 15 revenue recognition.